Welcome to Talk Tickers. We're diving deep into the numbers that, well, really matter. Today, it's ICU Medical, ticker ICUI. We're unpacking their Q2 2025 results and that conference call they had back on August 7th.
Yeah, and this one's important because honestly, the market reaction was, well, it was weird. You have this big headline beat, looked great on paper, but then almost immediately the enthusiasm just vanished. Huge sell-off the next day.
Right. So that's our mission here, isn't it? To figure out that disconnect. How did they get those margins up? That JV shift seems key.
Exactly. And maybe more importantly, why did the market just laser focus on those tariff problems, those macro headwinds?
Okay, let's hit the headlines first. The snapshot.
Yeah.
Adjusted EPS, $2.10. That really smashed the consensus, which was what, around $1.44?
Yeah, way above. Significant beat, no doubt. But, you got to read the next line immediately. Revenue, $548.9 million. And that's down 8% year over year.
Okay, down 8%. But they said that was mostly the JV transition, right? Selling off that lower margin piece.
Correct. Management pointed straight to that structural change. But still, a year-over-year decline. It complicates the story for investors right off the bat.
Fair enough. But the profitability metrics looked, well, pretty solid. Adjusted EBITDA hit $100.3 million. That's up 10% over last year.
It is. And the GAAP gross margin expanded nicely, too, up 300 basis points to 38%. So you have the EPS beat, you have the margin expansion. But like I said, the market's excitement was incredibly short-lived.
Yeah, and sell-off tells the story. It suggests investors basically said, okay, nice beat, but we're looking past that. What are the real risks here?
Precisely. They discounted the parts that were, let's say, non-recurring or purely structural and zoned right in on the guidance and those future macro risks.
So let's talk about that main structural piece, the JV deconsolidation. This was the IV Solutions joint venture with Otsuka. They essentially carved out that lower margin business.
That's the move. It immediately lifted the company-level adjusted gross margin, hit 40% for the quarter on an adjusted basis. It's a neat trick, surgically removing the drag on profitability.
But they didn't sell it all off, right? They kept a stake.
They did. They kept a 40% equity stake, so they still participate in the upside, just without the full weight on their own P&L. And Q2 actually got a $3 million boost from equity income from that JV.
Okay, $3 million. Is that expected to continue?
Management flagged that, actually. Said, don't expect that same level in the back half. There's some scheduled plant maintenance, apparently.
And the cash they got from this deal, put to work on the balance sheet.
Straight to debt repayment. They've paid down $250 million in principal year to date. Total debt's down to around $1.35 billion now, and they have about $300 million in cash.
So what's the sold on the balance sheet? Getting healthier?
Much healthier.
Yeah.
And this is really important for the story. Management's clearly signaling a shift. Less about digesting the big Smiths Medical deal, more about becoming this focused infusion platform. They keep talking about getting leverage down to about 2 times EBITDA. That tells you their priority. Stability, cash generation, deleveraging.
Okay, so balance sheet improving, margin profile looks cleaner on the surface. Now the focus has to shift to organic execution, right? How did the actual core businesses do, the ones driving future growth?
It was a bit of a mixed bag, mostly positive. Consumables had a record quarter, $273.1 million in sales. That's up 4% organically. Solid demand there.
And they mentioned some innovation in consumables, too.
They did. They got 510K clearance. That's the FDA nod for their clave neutral displacement connectors. And they linked it to a study showing lower patient infection rates. That's a big deal for hospitals, always looking to reduce infections.
Makes sense. What about IV Systems?
That grew 2% organically. But interestingly, that growth was entirely driven by double-digit growth in their large volume pumps, the LVPs. Management sounded pretty bullish, actually. Said the segment is tracking towards potentially a record quarter in Q3.
Okay, pumps are key. And there's a bigger pump strategy here, isn't there?
Oh, absolutely. This goes back to the Smiths Medical acquisition rationale. They just submitted 510Ks for the Medfusion 5000 syringe pump and their CAD ambulatory pumps.
So more regulatory filings.
Right. But the strategic goal, the really big prize, is to get all these pumps, LVP, syringe, ambulatory, onto one single software platform. Think about it from a hospital's perspective. Less training, easier standardization across the whole enterprise. That's the vision.
That sounds powerful. But they seem to be pushing the timeline out, especially for the big Plum 360 pump replacement cycle. They're calling that a 2026 thing.
Yeah, they are definitely framing it that way, not a significant 2025 contributor. They seem to be managing expectations very carefully, maybe trying to de-risk this year, given everything else going on.
Which brings us to the less shiny part of the results.
Yeah, the soft spot. Vital care. That segment was down 4% organically. And even if you take out the IV Solutions part that they deconsolidated, the rest of Vital Care was basically flat to slightly down.
That's still dragging things down.
It is. Management admitted it's dilutive to overall growth and to that nicer gross margin profile they just achieved. It's kind of the anchor they inherited from the Smiths deal.
Yeah.
Optimizing that seems like the next big strategic challenge.
Okay, let's pivot then. Let's talk about what really seemed to tank the stock post-earnings. Tariffs. Management basically said expects the full year tariff hit to be at the high end around $30 million.
Yeah, $30 million. And that includes an extra $5 million hit from new reciprocal tariffs. That incremental bit is mostly because the rate in Costa Rica went up from 10% to 15%.
And Costa Rica is a big manufacturing location for
A
them?
major hub, yeah, for some high volume stuff. So that $30 million isn't just noise, it's real cash impact.
Okay, here's the part that seems confusing, or maybe where the market disagreed. Management said, despite this $30 million tariff headwind, they're sticking to their full-year adjusted gross margin guide of 39–40%. How does that work? They're implying they can offset it all.
That's exactly what they're implying. They basically need the back half gross margin rate to be above 40%. They argued they can do it through, pricing, cost control, squeezing out more synergy.
But the market didn't buy it.
Apparently not, because at the same time, management did narrow the adjusted EBITDA guidance. They brought the top end down. New range is $380 to $390 million.
So the market focused on the EBITDA range tightening, not the gross margin promise.
Exactly. The market essentially said, we hear you saying you can offset $30 million, but we see you lowering the top end of your profit forecast. We don't fully believe you.
Management tried to explain that, though, right? Saying without the tariffs, the guidance would actually be higher.
They did. They argued that if you strip out the $30 million tariff impact, the midpoint of the new EBITDA guide is actually $10 million above the top end of their original pre-tariff guidance. So the point is the underlying business is actually doing better than they first thought.
But the market's focused on the cash reality.
Pretty much. Investors seem to be treating these tariffs as, well, maybe permanent, or at least very sticky. They see that $30 million hit, maybe believe $20, $25 million can be offset, but that leaves a $5, $10 million real unmitigated impact. And they price that risk in. It highlights just how skeptical the street is right now about anyone's ability to push through price increases to cover costs.
It's a tough environment, though it is worth mentioning ICUI stock itself has actually held up a bit better than some peers, like the IHI Medical Device ETF over the, say, past month or so.
True, relative performance hasn't been terrible lately, but the whole device sector is facing these pricing and reimbursement concerns. So for ICUI, it forces their hand. Cash generation, paying down debt, those have to be the priorities right now, maybe even over chasing pure top-line growth.
Okay, let's shift gears. Time for our This Is Not Financial Advice segment.
All right, so we've laid it out. The company sold off hard, right? Over 13% drop after earnings, mostly on this tariff noise. And we know the big catalyst, that LVP replacement cycle, management keeps pointing to 2026 for that, not 2025.
So the setup is short-term pain, longer-term potential gain.
Kind of. It creates this potential structural opportunity based on timing. The market's reacting to 2025 problems while the company's talking about a 2026 story.
But if the market thinks those tariffs are real and maybe permanent, isn't there a risk that the stock hasn't found its bottom? You mentioned that $112 low. Why trust that holds if they can't fully offset the costs?
That's the critical question, absolutely. The reason to have some confidence in that floor, or at least near it, is the balance sheet repair. That $250 million debt paydown, that improves the enterprise value foundation, makes them less sensitive to just macro shocks alone. The trade is betting on that improved stability, providing a buffer against the tariff noise.
Okay, so how do you structure a trade around that idea? What's the pitch?
Given the high implied volatility after the sell-off, you can use options to structure a directional bet. The idea is to sell some defined downside risk. Maybe look at selling near-term, out-of-the-money puts. You're essentially betting that $112 low or somewhere near it holds because of that debt paydown cushion.
So collecting premium by selling puts, betting the floor holds.
Right. And then you use that premium collected, plus maybe some additional capital, to fund the upside bet. You'd look at buying long-dated call options, specifically deep in the money calls that expire out in late 2026.
So targeting the time frame for that pump replacement cycle.
Exactly. You're structuring a bullish trade that uses the near-term pessimism and volatility around tariffs to finance a high-conviction bet on that 2026 hardware refresh actually happening and driving growth. You're essentially saying the market is pricing in 2025 tariff pain. I'm using that to fund a position on the 2026 upside.
Leveraging the short-term noise to finance the long-term story. That's certainly an interesting structure.
It's about aligning the trade structure with the company's own stated timeline and the market's current focus.
Okay, let's wrap up this deep dive on ICU Medical's Q2. Quick recap. The headline beat looked good, driven largely by that JV mix shift. That helped margins and funded debt paydown. Consumables also showed solid organic growth.
But the big cloud hanging over everything is that $30 million tariff headwind. And the market's pretty clear skepticism about whether ICUI can truly offset all of that cost pressure, impacting their real earnings power.
All right, before we go, time for that final provocative thought for you, our listener.
Okay, think about this. Management is clearly aware that the vital care segment is dragging down the overall profile, right? It's dilutive to growth, dilutive to margins. It's the leftover piece from Smiths they need to deal with.
Right, they acknowledge that.
So the provocative question is, what if they actually managed to successfully optimize it? Maybe they monetize parts of it, maybe spin off some non-core assets within vital care. If they do that, how much higher could the remaining company's growth rate and gross margin profile realistically go? And critically, is any of that potential optimization already baked into the stock price today, especially given how much the market seems focused only on the tariff downside?
Interesting. Food for thought. If they clean up vital care on top of the IV solutions deconsolidation, what does the core platform really look like? We'll leave you to ponder that one. Thanks for joining us for this deep dive. We'll catch you next time.